We're live and rolling for a very special conversation with Matthew Helderman from BondIt Media Capital and Buffalo 8. Matthew, you are the co-founder and CEO of BondIt Media Capital. It's a very it's a name that's now really doing the rounds with filmmakers, with independents, and with a host of aspirants who want to sort of partner with you on getting their project off the ground, and of course getting your support and blessings. So would be a great time to start with a little bit of background and maybe an elevator introduction of the company.
Sure. No, and appreciate it. And feel free to jump in and cut me off wherever it makes sense to double click and go down any of the areas that I'll cover. But by way of background, BondIt's been around. At the end of this year, it'll be about 13, 14 years since we founded the platform. And when we started BondIt, it was in a moment in time where access to bank financing had become next to impossible due to regulation coming out of the credit crisis and things like the Dodd-Frank Act that had made content being financed by banks almost curtailed entirely, where you were no longer able to use depositor funds from a commercial bank to take content risk. Film, TV, types of sports, music. And so when we got out of undergrad and we were producing content, just seeing the difficulty and the access or the lack of access to reliable capital, and it was obvious to us in that moment that there was a market opportunity. So both from a regulatory standpoint and then just the demand curve that was really based on the fact that those were the early days back in 2012, 2013, where streaming technology had caught up enough for us as consumers to begin enjoying sort of interruption-free, high-quality, high-caliber content streamed at home. The demand curve went through the roof with places like Netflix and Hulu and Disney competing in the sort of early innings of the streaming wars, as it were. And then on the other side, there was a massive decline in availability of institutional and reliable capital because of the credit crisis sort of hangover. And so BondIt was founded in that moment. And both my co-founding partner and I had come out of a background, both having built a production and a post-production firm at Buffalo 8 and had experienced sort of firsthand that lack of access to capital. And then also both had been born and raised back east in Connecticut, families in the institutional finance world. And so we're able to speak both languages, speak to institutional capital as we went out and built this company at a very young age and raised capital on the balance sheet of BondIt for the purposes of not having to sort of drill a well every time we need a drink of water, was the analogy we would always use of, do we structure this as a fund or do we structure it as a balance sheet? And I still sort of go back and forth today on whether that decision was correct to sort of structure it as a balance sheet. But I think the other piece that's pretty relevant, just given sort of audience that you have and the demographic, in the moment that BondIt was founded in, fintech was also sort of in the early innings of getting these crazy valuations. Lending Club and Prosper, OnDeck, SoFi, Cabbage, all these companies were getting crazy multiples. And they were all structured either as balance sheet marketplaces that would then sort of either balance sheet a loan and then sell it off into syndicated secondary market, or they were just purely a platform to arrange two sides of a financial transaction. And so we were swept up in that moment of interest rates were super low. There was a lot of venture capital pouring into the space. And so youth and naivety, we structured the business thinking that technology would play a much bigger role than it has. I mean, it plays a role, but it plays a very different role than perhaps we thought way back then.
Fascinating. And look, I mean, the credentials are very, very impressive. Besides the fact that, close to $500 million to date that you guys have deployed, and 450 movies. Is that 450 films?
Yeah, it's about right. I mean, I would say about 450 film and TV projects, probably about another 50 or so across music and sports and creator economy. So think short form content, people creating content for YouTube and TikTok and Instagram and Facebook. So very similarly to how we finance in long form, short form is, I don't need to certainly tell you, short form is huge. It's large. It is larger and will continue to be larger than the traditional long form business. So we've deployed about $500 million on balance sheet, and then probably another, let's call it $100 to $200 million off balance sheet, where we've worked with the Fortresses of the world, the Susquehannas, the Crestlines, these big asset managers that want access to media and entertainment, but either deals are, you have to be in the trenches a bit more than big fund and asset managers want to be. And so we will originate deals, and oftentimes they don't fit our parameters, and we'll arrange it with a large institution.
That is fascinating. And Again, one of the aspects that I was struck by was just the young age that you guys actually sort of created the company. What's the story of the co-founders? Do you guys go back in college? Did you guys grow up together? What's that story?
Yeah. Yeah, appreciate it. And Buffalo 8 was first. So we
Uh-huh.
built Buffalo 8 in between our junior and senior year of undergrad. And both, again, grew up on the East Coast. My then girlfriend, now wife, had grown up with Luke since a young age. And so I knew Luke in high school, and we were friendly enough, but we weren't super close at that point. We got close in college, had a lot of overlapping loves of entertainment and entrepreneurship and business and merging of entertainment with entertainment technology that was all happening at that moment when we were in that great age of being young enough to work 14-hour type days. And we started Buffalo 8 first really as a one-off production company to house the liability of one in particular film that I wrote and directed and produced in between my junior and senior year. And that film then, when it was completed, took me to LA where Luke was at USC. And we took dozens of meetings with, call it what it is, very shitty sales and distribution companies, and just learned, there's this huge industry out in LA that you just fundamentally don't have access to in New York or East Coast. And it's dawned on me, and I wouldn't have articulated it this way then, but Luke and I realized, okay, if you have a business acumen and you can speak business language to East Coast finance, and you also have this real passion for the creative industries, there's a company to build at this intersection. And that was the earliest iteration of it. And then over time, it evolved to have various facets. And I think to your point of us being so young at that point, we sort of took let's throw things at the wall, see what works here, see what doesn't work. And for all of the divisions, I think today there's probably a dozen or so disparate revenue streams of the company. We've probably launched 3 dozen over the years. So the hit rate's been strong, but certainly there have been things we've launched that ultimately haven't worked and they've sort of faded away. And then over time, we've call it shiny ball syndrome and making sure we're staying super focused on the things that make sense. And a lot of that youthful shiny ball syndrome, we've been able to sort of weed it out.
No, that's fascinating. And, again, even the selection of the projects suggests that there is no shiny ball. There is really the overall attention to whether this is really a business, whether this project is really viable, whether it will return back the capital. I think that seems to be like a very careful selection in all the projects that typically come out from BondIt Capital.
Yeah, no, I mean, I think we've really whittled it down. What we'd like to believe, as much as obviously there's a credit box and an investment committee box through which deals have to fit, and that has become refined over, as you say, financing over 500 transactions. But also all of the things we originate that we say no to, just make that investment thesis and the lens through which we originate and underwrite smarter. And so on average, let's say we originate 1,200 to 1,300, give or take, inbound media financing opportunities every year. And so if you're only closing on 50 of them, it's like any other industry, right? You and your team are getting intelligence and detail and market context on all 1,300 of those deals that help you make decisions around the 50 or so that you're financing.
Right, that's right. No, that it's. I mean, I've been very close to the VC community. Friends and family in that, and it actually sounds very disciplined.
It's very similar. Yeah, very similar.
Very similar to that. Right. One of the interesting aspects about our industry, Matthew, is that I've always seen that in Hollywood, folks are very conscious of the fact that, it's a confluence of creativity and technology. No one puts business as part of it or just capital and the discipline on capital as part of that. But there is an angle to it. It's perhaps very foundational, just along with creativity and technology. Yeah. So I was actually sort of, I had two questions. Maybe I'll start with the first one. The Vitrina community is 100,000 people across 100 countries. Different markets are at different maturity in terms of capital or in terms of their own industries and how they are responding to box office and streaming and broadcasting. Wanted to actually maybe start with a little bit of an understanding of how you see the capital flows from your lens in terms of equity, debt, gap financing. If you can maybe talk a little bit about that aspect, and then maybe even touch upon, what's your play in that regard.
Yeah, for sure. So I'll start by saying we've been doing this, let's call it 14 years, give or take, in the next couple of months. In that time, we've seen such an evolution of let's think about the capital stack or the capital composition of projects. And in the earlier days, 10 years ago, there was a lot more equity in the market, a lot more private individuals, high net worth individuals that wanted access to film and TV investing on a one-off basis or with their family offices or whatever it may be. And I think that mainly, we've seen that curve come way down. And I think that's because the ability to make high outsized level returns in film and TV has just shrunk. And when Netflix, Amazon, Hulu, there's only a handful of super premium level buyers that can pay at a budget multiple to return to the equity at that level. There's only a handful of those buyers, and those buyers primarily have ring fenced their production activity to be primarily focused internally on things that they develop or on things that they commission based on all the data they collect from their audiences have streaming preferences. They know exactly what to basically serve up next, as opposed to, you think about like the heyday of the 90s or early 2000s with independent film, independent television. It was creator driven. It was director driven. They were creating what was the next zeitgeisty thing, as opposed to the Netflix algorithm feeding us what is next based on so much data. And so we've seen equity come way down as a result of that. To sort of compensate for it, we've seen different types of soft money and tax incentives around the globe, both domestically with things like tax code 180, which I believe is being curtailed at the end of this year. So that'll have an impact. But then certainly foreign countries, this will be the first year BondIt will shoot more than 50% of its content outside of the US in the history of the company. And we've seen that stat leaping towards that 50% mark. And this will be the first year that it crosses over.
Wow.
But it's because of equity drying up and streaming changing the economic upside potential on a project, shifting the amount of soft money you need. And you can really only access that soft money really over in different parts of Europe or Australia, or potentially parts of Canada. So you see this migration away from US production. And then I'd say the comment around gap or taking financing risk against unsold territories, we do it from time to time. There's probably 10 to 20% of our portfolio sits in gap, maybe a little bit more. But there's only a handful of sales and distribution partners. As a financier, if you're sort of being discerning in your underwriting and not sort of closing your eyes and throwing the dart at the board, there's only a handful of companies you can really take that risk with. And in some ways, that's great. I think it's a thinner market now in terms of the sort of top rung of the ladder. But you have to be much, much more careful in your approach to who you can gap finance with.
Fascinating. And do you see any sort of gaps within this industry? There are certain sectors where there's far more capital available and far more options available in terms of the way that capital is structured. As a supply chain company ourselves, right, that is focused on entertainment, we're finally getting some trickle of requests from financial institutions about supply chain financing, especially on the vendor side and maybe on the project side, especially if those projects are backed by large sort of streamers. How do you see the health of that piece? Is this underserved industry at this point from your perspective?
It is. I mean, I think as much as the industry likes to tout itself as being super progressive and ideological in certain ways and pushing culture and pushing the zeitgeist, the processes are so unbelievably archaic. Yeah. And I say that across the board. The way content's made, the way it's delivered, the way a delivery of a piece of content, both the legal side of delivery and the physical and technical side of delivery happen. It shocks me, honestly, how inefficient and how dated so much of it feels. And that's before you even get into the fact that you sell a piece of content to Netflix or Amazon or Hulu or Disney, they pay it out over 24 to 36 months in these installments. And so you're forced to go finance it. To pull that cash forward if you're going to operate your business efficiently. So it's just all of these incremental areas of certainly the process chain from start to finish of a piece of content that can definitely be refined, and they will be refined. And I think the elephant in the room, of course, is AI, and how is AI playing a role in this? Right. I can certainly say every single one of our analysts, everyone on our finance team, everyone on the creative side, everyone is equipped with enterprise level AI to be having it learn our processes, get smart on our sort of pushing and training of the LLMs around the data that we bring in, but then also having it really help enhance underwriting. I mean, it's remarkable how good even like ChatGPT 5 seems to be now around. We'll look at a new deal and I'll give it sort of a once over, and then I'll drag and drop the assets into chat and ask it to underwrite through the BondIt lens, knowing how we think. and prepare sort of a quick analysis on pros and cons on the deal, and then also blind spots that I may not be looking at with our typical underwriting approach. And the feedback is incredible. And so you have to just feel like and it's instant, right? I mean, it's what used to take an analyst several hours or take us, an hour can now be done in seconds. So it's pretty remarkable to think about the efficiencies that can come out of that.
That is fascinating, Matthew. I mean, just what you described right there as the process is fascinating. And again, when you say your lens, that again is highly qualified with all the projects that you go through and qualify. In that light, I wanted to understand, if you had to answer a question about your playbook, there are a host of folks who are listening to this conversation who would love to have you look at one of their projects. What would be what's the playbook at BondIt Media Capital?
Yeah, I think for us, ultimately, it's commercial content, things that have real business fundamentals. There's market demand for it, and that can be three legs, right? It can be IP driven, so something that has historical IP value. It can be talent driven, so the attachments to it are pre-sellable or sellable in the marketplace, or the whole package, right? It has multiple pieces attached to it. It can be an original piece of content, but a fantastic director, and there's some level of momentum that the producers have created around it before they bring it to us. So they may have a sales agent attached. They may have some pre-sales done. They may have a domestic distributor in place. Any of those things or any of that combination can ultimately work for us. And we're genre agnostic, although the market speaks, and everyone knows it's elevated genre, elevated horror and sci-fi and thriller and action are sort of the genres that travel globally, that there's consistent demand for, and there's consistent feedback from the marketplace, even when the market's tough, which right now the market is the most challenged I've seen it in my career. Even in moments like that, there's demand for global projects that can travel across those genres.
Fascinating. So in the three aspects that you described, IP, talent, and the overall package, I'm guessing Terrifier is in the IP bucket as an example, as a case in point.
Very much. Yeah, I mean, Terrifier is an amazing case study for so many reasons. I mean, I think, like you said, it was very IP driven. The second, we had the chance to do the second Terrifier, and we didn't. We watched from the sidelines as we work quite a bit with Cineverse, the distributor of that film, and have financed dozens of projects for them over the years when they were Cinedigm, and then into the Cineverse days as they pivoted to be more of a ad-supported fast type channel or aggregation of fast channels. We had done a lot of financing with them and watched as that project just blew up. It was an incredible success. But even from the sidelines, it felt like Terrifier 2 may have been overly enhanced from what sort of the COVID period. This was a movie that was released right in that window when people were coming back. And again, it was sort of this niche underground piece of IP around Art the Clown, the character that a lot of people sort of likened to the only original horror icon that's been created in the last 20 years, like a Jason or a Chucky or something similar. No one has really created that. And the pitch was fascinating in that Cineverse had bought Bloody Disgusting and all these online underground horror and genre blogs and fan sites. And they were able to mine that data around where audiences sort of congregated and the content in which they engaged in most. And so they early on, look, there's a lot of energy around this character that could ultimately cross over into the mainstream. And we hear pitches like that every day. So it's hard to take it and say, okay, this is gospel. We assumed, okay, maybe that's correct. Maybe it's not. And then we watched as Terrifier 2 felt like there's some level of crossover here. Certainly it crushed it at the box office. It was a $200,000, $300,000 budget, and it did $12, $13 million at the box office, and another, let's call it 10 million, 8 million in home entertainment on a couple $100,000. Those movies are very few and far between, as we all know. And so when number 3 was an opportunity, it was legacy IP. It was riding all of this momentum. And the data, frankly, that Cineverse was able to show us around just online traffic activity, it suggested this thing was going to be huge. And it suggested that it was going to be, ultimately it ended up doing 90 million at the box, and it's done tens and tens of millions of dollars in home entertainment. And, it had a $5 million budget and $1 million of advertising. It's a remarkable story of this world that's been created. So that movie was both the deal structure itself was a great deal, but the IP, as you said, was legacy IP that was just becoming mainstream with that movie.
Fascinating. No, that's a great case study. And again, I was going through that in sort of preparation for our conversation. I wanted to double click, Matthew, on one aspect that you talked about, which is, you mentioned that this is perhaps the most stressed financing has been,
Yeah.
in all your experience. Can you describe what's different? Is it like just the perfect storm, just too many factors all coming at the same time? How would you describe the causes of the problem? Or is it just a broken business model that's also come to haunt the industry?
So I think I'd start by saying at the end of 2022, we as a company were riding in the industry, but as a company, we were riding at an all-time high. We had grown substantially during the pandemic when the demand for home entertainment was the highest I had seen. Simultaneously, you had historically low interest rates for a very extended period of time. And so there's a lot of margin there, both on the profit, but there was also, if you're Netflix or you're Lionsgate or you're any of these large buyers, your willingness to draw down on your own credit facility to buy content was much greater because money was cheap, right? You could finance, it's like anything. When interest rates are low, you can use super cheap money to build your asset base. And these distributors were doing that at volume. At the end of 2022, when the Fed started increasing interest rates, and then simultaneously Netflix reported its first, you probably remember, its first subscriber decline in a quarter for many, many quarters. That moment was an inflection point where just the monetary and financial reality of the tightening, every distributor started tightening. Netflix then started buying third-party content much, much less because at that point they were so focused on financing in-house content. And so what's called pay one, they're the pay one window. The SVOD window is now the pay one window. The SVOD pay one window options as to who you as a distributor or a producer could sell to had dried up because Netflix, Amazon, Hulu, Disney, all of these places started focusing primarily on in-house production, hoarding their cash because rates started for that next 12 months. Interest rates went up. Interest rates went up almost a dozen times, right, over the course of almost 18 months. And so you just saw a complete stair-step change in the opposite direction coming out of COVID. Rates obviously had remained super low. Everyone was at home just gobbling up content. That period ended toward the end of 22. Rates went way up, buyers started buying less, and streaming started focusing on homegrown content based on data, as opposed to buying content from independents. And so there was a shrinking in the market of domestic buyers. So I'd say that's been a big factor. The other factor has been just the continued onslaught of technology marching into foreign territories that, whether that's European, whether it's Latin America, whether it's Australia, a lot of countries' adoption to video on demand technology, whether SVOD or AVOD or TVOD, that has been much slower than North America. But then all of a sudden coming out of that period, it felt like every other week a foreign buyer was either going out of business or merging with another out of defense because the theatrical market had largely just gotten, I wouldn't call it nail in the coffin, but certainly to a large extent, it turned a very dark corner of unless you're making, again, back to the comment around IP, unless you're making legacy IP driven, big escapism content, going theatrical doesn't make sense. It's too expensive. And a lot of those foreign buyers, their business models are hinged around a continual theatrical market. But you can't justify the expense of a theatrical caliber movie when North America, there's no money to be made in theatrical unless you make a bigger project. And so it's this mismatch of expectation setting of what the project is and where its value lies, all happening at once in a period where interest rates have remained much, much higher, certainly than they have in the last 15 years, for the last several years now. It's all of these things happening at once. I don't think we're through it by any stretch. I think we're still going to see M&A. We're going to see bankruptcies. We as a company, we track certainly the number of bankruptcies and the number of, I'd call it sort of defense-driven mergers and acquisitions. People going through a transaction because they have to, not because they want to. It's at the high that I've seen. The number of companies folding, the number of companies having to merge, and these are folks, a lot of whom we've done significant amounts of business with over the years, and their whole model has to shift. I think for us, where there's a plus and a minus for it from the BondIt business model, which is capital is the scaffolding of every single industry. That's not going to change for entertainment. It may change how and where and who we deploy it to, but financing is still the scaffolding of how everything gets done. So that's a positive. The negative is a lot of what has worked will not work going forward. And so if you're BondIt's under $200 million, but under $200 million capital out in the marketplace, moving those assets as those deals come back and collect into new assets that we deploy them into, it's going to look fundamentally different. It's going to be different short form. It's going to be different television. It's going to be different soft money. All of these things that are changing, and it's not gradual. It's all at once at this point.
That was no. All the aspects that you called out, actually, we've seen the impact of that, and it's a drip effect of a lot of those aspects hitting the industry. I wanted to go back to one of the things that you said that was super exciting and interesting, which is 50% of your projects are now international. I had two questions relating to that. Which are the top two markets within the scheme of things? And then, is your ticket size different in the size of the budget from a US project vis-a-vis an international project? You can talk a little bit about those two aspects.
Yeah, it's a great question. So domestically, New Mexico, Georgia, Mississippi, Kentucky, Ohio, states that have attractive credit programs are the most consistent. Ticket sizes range. Our minimum ticket size is going to be $1 million up to $15 million. Sweet spot is in that 5 to 7, 5 to 10 type range. And that sweet spot is consistent both domestically and abroad. We really don't want to go below that threshold, and very rarely are we going to go above that. Not because we don't want to, but because if a project is budgeted at that higher tier, oftentimes those producers can access a commercial bank, and the bank will certainly be cheaper than us. And so we will win deals on speed and flexibility and the ability to be entrepreneurial with the capital. The areas abroad that we see a lot in the UK, Ireland, which has a different tax credit than the credit in England, Ireland and UK quite a bit. As I mentioned, we've now done some things in Italy and France. I will say we have not financed those credits. We have quite a bit of the credits in the UK and in Ireland, but we have not France and Italy, but they're starting to become much more prevalent. Same thing in Spain, much more prevalent. We've done a lot in Australia. I think Australia has done a really good job of being a relatively small territory. They have a very strong credit program, and it's enticing, certainly on a global level, to go and base your production out of Australia now.
That is so true. Actually, we track projects and productions globally, and Australia is such a hot market. In fact, a lot of the provinces themselves and provincial governments come in, and they also add to the overall federal programs. So it's a pretty exciting market from that perspective. Very much. Totally agree. So the one element that I was then curious about was relating to new markets that you are opening up. Looking at least some of the projects coming in. Yeah. I mean, look, I think I met a group of you guys 4 to 5 months ago, that remind me of a smarter version of myself when I was their age. So they're probably about 25 years old, and they have built a largely AI-driven piece of underwriting technology that syncs directly with someone's YouTube dashboard. So if you're a creator and you have a library of 500 pieces of YouTube content that are out there, you're monetizing them with ad revenue 24 hours a day, 7 days a week, and you're continuing to release new content on top of it. They built an underwriting model that allows you to automatically go in and with AI underwrite how much on a conservative basis, or you can lean into more risk, or you can lean into a lot more risk, but how much on a conservative basis you can provide effectively a loan against that existing library of YouTube catalog, and then use the cash that you're providing them for the creator to create new content that is targeted around the areas of that library that have been the most value add from a monetary standpoint. And I look at that and just say, that's obviously the future, right? I mean, it's automated underwriting for short form content that I can do instantly for creators that oftentimes it's a one man or a one woman band. It's not some big infrastructure with a production team and huge processes like long form film and TV. And look, I think as an audience member, I don't love it. I mean, it's upsetting to me that we're sort of losing, in a lot of ways, a great director-driven, auteur-driven mentality. But it's just evolution of content. I mean, I think I had a great meeting, it was last week before, where someone articulated it so well, which is, for all the griping of how much the business has changed up until now, you think, cable television, and you go into network television, then into cable television, then into home video with VHS, then into DVDs, then into streaming. All of that change, even while it was difficult and challenging at different times, the format of the content is still a 90 to 120 minute movie, and then television series that are either 20 minutes, 40 minutes, or 60 minutes. Whereas now
the entire format is changing. So not only is the delivery method with technology changing, but people are watching 10-second pieces of content, 60-second pieces of content, micro drama content. So this change is fundamentally different than what prior generations have dealt with, because the actual format of the content is shifting, not just the delivery method and people not going to theaters, but consuming movies at home. They're just not consuming movies. They're consuming short form pieces of content. And so for us, in terms of new markets, it's where are people's eyeballs? And there's a firm folks probably familiar with called Shamrock, Shamrock Capital. They're probably the creme. They're the creme de la creme when it comes to media investing. If I think about what I would want BondIt to be when we grow up and the firm grows up, it's Shamrock, and they invest across the whole ecosystem of media and entertainment. And one of the founders said to me last year or so, as I think about BondIt's, to this question, how do we evolve and push into new horizons and new markets? If someone has 100 units of their media diet and you're investing only in film, you're investing in like 10% of their diet. Why would you do that? That would make absolutely no sense. Like you're a capital provider. You can deploy that capital across the full 100 units. And so to us, it's how do we evolve the model to address those 100 units?
Fascinating. That makes a lot of sense. And again, the business is changing so rapidly. We did a special on micro series, such a fascinating category.
Crazy.
And so much money to be made.
Wild.
Real Short apparently made 40 million last month, and they're on their way to becoming a $500 million.
It's insane.
Company. Incredible.
It's insane.
Yeah. So there was one particular aspect, Matthew, that I was curious about, and this is something that, again, I'm sure a lot of our members will take a lot of attention to. The top 3 reasons for rejecting projects. Was it the team? Was it the indiscipline? Was it the lack of clarity on the business model? What are the I don't want to bias you with things.
Yeah. I mean, all of the above. I mean, I'll try and put them in some level of an order. A lot of things that come to us. Someone wants to make a $20 million biopic about a baseball player. The movie's never going to happen. The market doesn't make sense. Movie's historically difficult. You don't have any equity raised, and you're coming to us at a super early stage with challenging subject matter, challenging genre. I just say there's just not a realistic sort of business approach or market fit approach, market demand approach for the project. And I would categorize that as well of just people misbudgeting how much they think a piece of content needs to be made for, which is one discussion, versus how much is the piece of content actually worth in the market. We'll have people send us things and say, well, it's going to cost me $20 million to make this. The line producer may tell you that, but I can tell you that a buyer is going to buy it for $5 million. Who's taking the $15 million write down? It's not going to be me. That's not our business. It's not our business model. We're not interested in that. And so I think I would bucket that all into just sort of a misalignment of the business expectations of a piece of content. It's the second reason to pass on things would be that, to your comment around team, the pieces that you've attached to it are doing more of a disservice. They're more liability than asset to your package. And that could be director, it could be writer, it could be cast, it could be financier, it could be sales company. You have to be super discerning. I know my partner Luke has said this in the past in interviews and discussions that a lot of our business is kissing frogs early on and learning sort of where not to do that again. Doing your homework and building your package requires you to kiss a lot of frogs. I would just suggest to folks, kiss those frogs without putting any binding agreement in place with them where now they're attached to your project or projects going forward, because that makes it really difficult. Like there's internally, I won't say who the bank is, but there's an entertainment bank in town that circulates a quarterly blacklist of producers, buyers, distributors that all the financiers look at. And it gets updated before each market. It just got updated now before Toronto in the next week or so. Around the corner. Having a seasoned producer who knows sort of who would fall on that list or who is on that kind of a blacklist is really important, because it will just make it an automatic no for someone who knows the business.
Right. No, that's fascinating. This is I'm going to try and dig a little deeper on that one, but not in this conversation.
Yeah.
Matthew, one aspect that I wanted to understand was just the ecosystem that you have today vis-a-vis what your vision is. I know Buffalo 8 is kind of part of that ecosystem, but does the ecosystem eventually also train some of the folks who are coming to you with projects and great ideas in mind, but just don't have the understanding on either the business side or the right team and getting the right team in order? There could be lots of different mentorship that some of these storytellers may require. Is
Yeah.
that something in your roadmap? How do you
Yeah.
describe your ecosystem?
Yeah. So I'd say we look at it as a flywheel. And the
Uh-huh.
flywheel starts with the BondIt side. And the BondIt side certainly starts the flywheel in motion. And as that grew, so too did our post-production business at Buffalo 8, requiring projects we finance to use our post business. The post business is now a very meaningful part of our operation. 50% of the projects that go through post per year are things we finance. Another 50% are just organic sales or organic repeat clients. And so it's a great standalone business. Same thing with our domestic distribution business. Based on the amount of volume we're originating, people come to us and want to distribute projects because they know the market intelligence and the deals and relationships we have in place given our market positioning. So the Buffalo 8 distribution side is now 500, 550 titles, give or take, that we own on a
Wow.
10 or 20 or 30-year license. And you're distributing that out. And to me, that's the real asset that you're building. Yeah, the real annuity to the business. The other piece that some folks may know is we bought in 2017 an entertainment payroll company called ABS Payroll. Been around since the late 1980s. And the thesis there was we would buy this company, acquire projects we finance to utilize it, and we would then reinvest in technology and personnel and branding and up tier the company. Went head down, executed on that, and in 2022, a private equity vehicle backed by Mitt Romney bought 80% of that company from us. And
Wow.
and we still operate it day to day and still own 20% stub piece as shareholders. But it made us realize, to your comment around ecosystem, BondIt is the flywheel. You're financing all of this content per year. What are those satellite businesses you can build off of BondIt that can then ultimately not only help protect your financing portfolio and grow your pipeline, but also then you could carve them off and sell them over time to different private equity or different strategic partners. And so when I think about where we are now and where we're going, we're in the process of a meaningful transaction for us where we're merging Buffalo 8 and BondIt into a holding company with a private equity shop out of New York who are purely in media, entertainment, and telecom. So merging those two business units and injecting effectively a war chest of capital to go do strategic M&A. And whether that's buying an existing finance business that's in another jurisdiction like Europe or Australia, which is certainly on our list, or buying a set of bankrupt sound stages that someone else has run into the ground that we would take over and then require projects we finance to utilize. And now you have a real estate asset you own and you have a rental business, all the way to buying CPA and accounting firms that we would require utilize on all of our projects. It's how do you integrate what are the picks and shovels of pieces of content you finance? Why don't we own the margin on all of those? And why don't we integrate those business units? The education piece is a big part of it. We've certainly with some of the soundstage type exploration, we've met and sat with different universities around, do you have an integrated internship program or education type onboarding program to facilitate? It's a win-win certainly for everyone to do something like that.
That is fascinating. And again, I mean, with the business acumen that you bring to the table, having that ecosystem as a very strong foundational path for a lot of storytellers would be just fantastic. How large a war chest are you sort of thinking about? Is that something that you've talked about?
Yeah, no, I can't. I mean, it's tens of millions. It's not hundreds, but it's and these guys, great shop. They've rolled up all kinds of assets across film, TV, music, live entertainment, and it really is a great next chapter for where the business goes from here.
Fascinating. So in the last segment, I wanted to sort of look at outlook and roadmap, Matthew. In terms of just the roadmap that you have, you talked about AI a little bit. Are you sort of beginning to see projects or filmmakers that are using a lot of AI, any new technologies? There is also, again, as a supply chain company, we are seeing a lot of buzz about ad solutions. Fast tech obviously is big, but a lot of AVOD solutioning worldwide seems to be emerging. A lot of inventory seems to be now getting out of just that YouTube stranglehold. And a lot of other companies are now building up their big war machines, Prime Video, Netflix, and then a host of other regional players have this massive advertising solutions that might actually bring in a lot of new money and revenues into this industry, might become a very interesting addition to revenues for the sector. Just in terms of, your roadmap and outlook, AI, you talked about sound stages, ad solutions. How do you look at that?
Yeah, no, I think if you're not using AI, it's not even a growth map. It's just a necessary, it's table stakes, is the reality of it. You've got to be using it. And I know it's funny, I got introduced to this course that I'm debating taking, which is, you're using AI. The name of the course is something like, you're using AI like a late 30s, early 40-year-old. You don't know what you're doing, and you really should take some level of course to understand all these different enhancements that it can be offering your workflows well beyond the way you're using it. So to us, it's how do we educate the wider team around we're probably using and just scratching the surface of the applications that it could add to our business. So how do we use it in those much bigger ways? So AI is a huge piece of it, whether it's originations, underwriting, documenting, CRM systems, and the ability to crunch large amounts of data from all these deals we've originated over the years to help us refine underwriting. We really need to be leaning into the technology side. And then on the post-production side, we have something very fun up our sleeve, which is building basically a consumer level post-production piece of software that we're going to offer out into the market that is AI driven. That's sort of the first, basically, again, everyone with a phone in their pocket is a creator. Why doesn't everyone have access to Hollywood level post-production suite of tools? AI now enables that. We want to be the first to roll that out into the market.
Fascinating. Last question relating to Outlook 2026. How's your sort of how's the deal pipeline looking for BondIt, and then for the industry, how do you see the way forward?
Yeah, no, like I think our pipeline remains strong.
Okay.
The portfolio, battling through rate hikes and M&A and bankruptcies, all of that it's been a battle. Like every day, and this year is nothing surprises me anymore, but it doesn't make it any less challenging. It's definitely a battle. I think it will continue to be. I think 26 is a similar year. I think as rates come down, maybe that helps some of the easing, but I think that takes 6 to 12 months for it to fully pass into the market and for everyone to feel it. My prediction going into either the end of this year and top of next is there's going to be a lot more M&A, and we certainly want to be in a position to transact and get deals done in a moment where I think we've probably grown about as big as we can organically. I think A is certainly the way forward for where we are now.
Got it. And if people within our network want to reach out to BondIt Media Capital, any piece of advice, what would you expect them to do?
Yeah, no, we're always an open book. We want to look at deals across the board. Single pictures, slates of projects, television projects, podcast opportunity, digital content, people that want to buy libraries, people that want to buy distressed assets, anything media related. Happy to look at it. And again, to our earlier part of the conversation, as we collect on our current active portfolio and think about how we redeploy it, I want it to look and feel fundamentally different than it has in the past, because it has to. So we're very much an open book, and we're out there telling the broader company story of we've been really entrepreneurial our whole run. We have to be, and we will continue to be entrepreneurial on this next chapter.
Fantastic. On that note, Matthew, congratulations on your success. Just such a strong media brand. And thank you so much for talking to us with the transparency and articulation that you actually described the business, the environment, and also the outlook. Thank you so much.
No, appreciate it. Thank you for having me on. So kind.